While corporates continue to be pretty rock solid, you got double B's below 3. That leads Nat Alliance this morning to suggest that maybe that provides some signs of stabilization on the 10-year, maybe below, they say 136. We'll see.
Yeah, I mean, where we hit 133, somewhere in there. Quite a move in yield in a very short amount of time. And, you know, that you're starting to hear that more often, at least in the conversations that I'm having, the idea of are yields done moving lower in any way? Are they going to continue to move higher? Are we going to see the curve itself steepen to some extent? You know, you've got, as you pointed out, Carl, some fairly strong numbers in terms of parts of the economy right now, despite what's going on in Texas and some of those other states. You've also got the prospect of $1.9 trillion coming into this economy pretty soon. And the checks that go along with that. And you referenced Goldman Sachs's work in terms of how much of that will be saved and how much will be spent and how much already has been saved and how much will find its way potentially into places like Robinhood accounts and the stock market. But, Mike, I don't know if you hear it more often, but I certainly do, at least, that question of could there really one day actually be a return of inflation? Are we already pouring fuel on a pretty hot fire to begin with, given people are getting back to sort of life? A lot of the country already is, but that return to normalcy, the spending that will come along with that, and then $1.9 trillion on top of that. Yeah. And by the way, potentially an infrastructure bill following on that. You know, the idea that there won't ever be inflation, I guess a lot of us kind of these last 20 years, whatever it's been, you've grown up with that idea, but the yields are starting to show a little something different, not to mention, of course, that desire from anybody anywhere to buy anything that's got some sort of an interesting yield on it.
Yeah, there's no doubt. I think everybody expects. I mean, just the math was going to get you a little bit of a burst in inflation, at least on a reported basis, over the next few months, because we are going to anniversary the crash. So everyone's been bracing for this sort of statistical, cosmetic inflation outburst, so to speak. But people were going to say, you have to look through it. It's really not going to be something that's a new trend. And the Fed, of course, is trying to engineer inflation and has been trying to prepare investors for the idea that they are going to be tolerant of significantly higher inflation for some time to come to essentially counterbalance all this time we've spent under their target of 2%, right? So that's been the playing field. I think right now you have to wonder about, the retail sales number in January. Everything is running a little bit better than expected on the consumer spending side. And then, even on the inflation side so far. And you look at the bond market right now, all it's doing is kind of normalizing rates. If we were at 1.5% a year ago.
But, Mike, what if you had a real curve? What if you actually got back to one that you and I may remember?
We do have a real curve because we were at 1.5% on the 10-year a year ago, and the Fed funds rate was at 1.5%.
Right.
So, it's starting to become a real curve. What's interesting to me is if you look at things like the 5-year, that was at, 35 basis points 6 weeks ago. Now it's pushing 60, right? Not a big move, not high rates, but it's showing you that the market is unable to ignore the idea that the Fed may have to respond. By the way, what does the retail sales number do to that $1.9 trillion everybody's expecting? Are people going to say, hey, we're at 6.3% unemployment, everything's moving fast, we're reopening, do we need that much?
It doesn't seem to be stopping it. I mean, that seems to be moving along. But, my question to you then would be, all right, if we get back to rates that perhaps we are accustomed to, but perhaps some other market players are not. What does it mean for growth stocks?
Yeah,
I mean, I'm looking at this Goldman Sachs note on Palantir this morning, right? They upgraded to a buy because it's growing at about 30% plus, and they say that deserves a 44 multiple on calendar year 21 sales. Yeah, right. So what happens in an environment where we get 2% on the 10-year to growth stocks like that or higher and a real curve?
Right. No, well, what's interesting about that is the pre-earnings, or I guess Palantir technically not pre-earnings, but if you're basing it on top line, I don't even think it matters as much for that. I'm looking more at Apple, which has bond-like characteristics in terms of its cash flow stream, in terms of the way it distributes cash to shareholders. That's where the big market cap weights are from growth stocks in the NASDAQ and the S&P 500. And that, to me, is much more sensitive to changes in yields and inflation expectations. And that's probably where you get the valuation compressing, Carl.
Shepard Smith here. Thanks for watching CNBC on YouTube.